Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. We're going to do our daily update of social media, is what I'll call it, on Twitter. It's generally related to three different topics: wealth building, commodities, and/or financial topics. I interject my financial opinions as we go through it, and I like going over this stuff to see what other people and opinions are. And sometimes I miss sectors that other people are charting. And I'm like, wow, that's a really good entry point on that company or sector. So let's dive in here. Let's see what people are sharing on social media. If you want to follow me, it's at Finding_Finance. And if you want to join our community, finding-value.com, where I dive deeper into these topics, looking for potential investments. You can see my entry points. There's these great windows of opportunities to enter some of these commodity stocks at very low valuations. So I am trying to time my purchases of undervalued assets when they're undervalued and when the technicals tell me to enter. That is what the value of the website is, are those entry points and learning about um, the investments. Not just learning the fundamentals necessarily, but learning the entire strategy of the whole system, macro picture and the real estate cycle, how it all kind of intertwines with each other. We do have a coupon code MAYDAY, MAYDAY, that is still active if you're interested. So the Happy Hawaiian here says home price crashes occur roughly twice per century. Per century, guys. They are generational moments. 2008 was recent history when talking about home price crashes. It would be unprecedented to have another price crash so soon after the last one. So this is the timeline of major housing crashes in the United States. The Panic of 1837, 1873, the 1873 stock market crisis. In 1929, the Great Depression caused by Wall Street crash in 1929 is what they put. And then 2008, the housing bubble burst in the US, leading to the global financial crisis. Now, in 1929, home prices did not crash because it was caused by Wall Street. Wall Street crashed because of the real estate market crash in the middle to late 1920s. The real estate market is what causes these crashes, and it's ultimately bad loans in the system that causes it. It's a deleveraging event in the system where credit goes bad. That is, by definition, deflationary. It's credit being destroyed. So a lot of these guys on YouTube calling for this big housing market correction of 30% or something like that on a nationwide basis, you're basically calling for another great financial crisis. I don't see the stresses in the system for that to occur in, at least not yet. And these guys are most likely going to be wrong because the home builders are still going up. They haven't peaked and turned lower. They've actually broken out of big patterns to the upside, which could mean that we've got further upside ahead of us. So I think they're wrong. And the big deal about this is the real estate market drives your uranium stocks, drives the oil prices higher, and drives all of the things that we're in higher. And you should be paying greater attention to the real estate market than financial markets. Financial market's going to go wherever the real estate market goes, for the most part. And then the money rotation is going to rotate in an expansion phase of real estate from financial assets like bonds and stocks being the S&P 500 and also the Nasdaq, into commodities and precious metals. That's what it's done in history. Richard Meyer says, record demand for U.S. natural gas electric power this spring. The importance of natural gas only continues to grow as solar and wind increase and coal declines. And remember, natural gas is the swing producer when solar and wind are not. Also, natural gas is being installed where coal used to be. They take coal power plants, remove them, and put in a natural gas power plant. Then they run all of the renewables to the natural gas hub, so to speak. They convert it from direct current to alternating current, the solar and wind, or they run natural gas as the swing producer at that area. This is what it looks like from 2005 all the way up to 2024 for May. Huge increase in demand for natural gas. And I think that this is a trend that will continue. And with artificial intelligence and other large electricity demand things going in place, electric vehicles, all of this other stuff, I think natural gas will be the backbone of the entire system, which scares me. It scares me because all it's going to take is we're one cold weather away. We are one hurricane away from natural gas spiking like we've never seen before. I mean, a big spike because we continue to add demand, demand, demand. We've been on the right side in terms of weather for 2 winters in a row. We've got Europe that has really it's in a real fragile state. People look at inventory levels and say, okay, that's okay. It's like putting a gigantic V8 in a four banger car. So you engine swapped it, but you left the gas tank the same size. So the gas tank's like 11 gallons, 12 gallons in size, but now we're only getting 8 miles per gallon. We've added all this demand in the system, but our inventories haven't really grown in terms of days of coverage. So we're looking at the inventory level with the same perspective as we are in 2005, but our demand from 2005 has over doubled. So we've doubled our demand easily, and we never increased the inventory size. But at the same time, Europe has lower flow rates. Our flow rates are they're going to be very sensitive. And we're basically leveraging up to weather, which scares the crap out of me. It really does. What's your most contrarian personal finance take? All right, here's my most contrarian personal finance take. I think that going to college is not as valuable as what most people think. I think that I'll say this. Going to college for a lot of the majors that people get is not as valuable as what most people think. Going to college just for the sake of going to college, I think it's not worth it. You need to go there with a specific purpose in mind. So if you're not going to go into a high paying career, then use college at like a community college to learn about math and physics, which I think are the only things that you really need to go to school for. You get math, physics, maybe a little bit of philosophy in terms of how to think. Once you figure out how to think, then go into an area, whatever area it is, where there's a large imbalance and also that you like doing. So those are my combination of things. Go where you learn to think and you learn about the world through a mathematical viewpoint, and then take whatever you want and apply that to the world now that you can think. So once you are able to think and solve problems, then go out in the world and find where the problems need to be solved to get paid a good living wage. I don't think engineers in the future are going to make great money. When I was an engineer, they don't make great money, but some people do. They're like, well, you make a six-figure salary. It's like, well, there's a lot of other areas that make really good money, like carpenters. You could open up your own company installing windows. I'm sure they make a good amount of money. You can go cut grass and make a good amount of money. And you don't really need all that education. You don't need to go through a really difficult curriculum to come out and you can cut grass for the same amount of money with a small business that you create. It's So, I mean, that's my take there. And maybe I'm wrong. Maybe other people disagree, and I'm fine with people disagreeing. But that's my take there. Is find something that you like doing, learn how to think, come out, and if you can start your own business doing something that people need and want, all the better. It says, would you work at a toxic job that paid 150,000 per year? If that was my only option, I would do it for a while. Yes. If it was my only option. Now, if it's not my only option, and you're talking about in the position I am in today, no, I would not take a toxic job that paid 150,000. I wouldn't even take a regular 9 to 5 job at $150,000 per year. You would have to pay me more money than 150 for me to take it. In fact, you may even have to double or triple that for me to be like, okay, I'll go work there. And that's me like thinking, not now. Here's the thing. That's for me taking a job. Period. That's a 9 to 5. Not even toxic. Toxic. I wouldn't take the job no matter what if it has a detrimental effect to my well-being. So I would have to get paid a lot. I mean, a lot, like a butt lot, like a butt ton of money. Drug says, or drug money. What is the best financial investment you've ever made in your whole entire life? Well, from a returns perspective, I would say that the best financial investments are investments that increase yourself. It's investments where they may not take a lot of money, but you can earn a lot of returns on it. And that's generally related to you learning a skill uh, on something. So a really good skill would be being able to sell yourself during an interview, but practicing and going through to becoming a good interviewee and being able to talk, I think is one of the most valuable things that you can do. And you probably don't have to spend a lot of money to get better at it. You just have to go do it. Or you can maybe go take a class or two on it, and it's going to return probably many thousands of percents for the money that you've put into it. I also think that if you get a mentor or you figure out a way to learn how to invest, I also think that that's a huge thing to learn. So even if you pay like $500 or $600 to learn it, I don't think that's a lot of money. I think that's actually a really good idea. Is how do you figure out on the largest financial decisions in your life, how do you get better at either selling yourself for those financial decisions, like getting a job, or better preparing yourself financially for like how to win at the game of life? For instance, your largest purchase is your home, so you should know, what's a good interest rate, what is free refinancing, all of those things that you think about, you should know about. You should know about compound interest and how it works. And when it works against you, it's bad. When it works for you, it's great. Like that's the biggest value that you can have is knowing that information, I would say. Uh, versus inflation, was this all a mirage, a simple back test of the breakdown? So he's got the Nasdaq versus the producer commodities. So it's all commodities. And to me, we've got a huge double bottom here. This was in 2002, 3. It came on up, and then we had a crash all the way back to 2009. That's your double bottom. We had a breakout. That breakout occurred in 2012, 2013. And then we ran all the way up in this big bull market. We've had a breakdown in 2022. We've gone and done a retest here. A back test is what he's got of a potential bearish rising wedge. And we can see a breakdown where the producer price index starts to outperform the Nasdaq. That's when commodities go ballistic, Goose. That's when they go ballistic, and that's when you need to be in them. I grabbed them in 2020 when they had that negative oil price. I grabbed them a little bit after that. I grabbed them in September, and I just looked at the oil and gas equities and I said, these are completely mispriced. They had really good chart patterns too. They had all these bottoming patterns going on. So I do think that we're going to see a big move lower. Why do I think that? What other information or confluence of information do I think where we could have the producer price index go down and go and outperform the Nasdaq? Here's a couple of things. These are the things that I would ask. Why are copper stocks all putting in these gigantic bottoming patterns and at the ideal buy location? Why are oil companies putting in inverted head and shoulder patterns and are basically scribing out the right hand shoulder of it? Why are rare earth metals also putting in bottoming patterns? So when you look across commodities, they're putting in bottoming patterns, just like this pattern is here. This is a double bottom. All of shipping, tankers, all of these things are located where this breakout is at. They're at this breakout and they're about to make this big run that's ahead of us like this. And right now, this is showing a breakdown for Nasdaq. So my question would be, how could you go against what I just said? All of the charts are putting in bottoming patterns for the most part. Fertilizers, oil, energy service, copper, base metal companies like diversified mining companies, they're all breaking out. Everything, tankers, dry bulk shipping, coal is, palladium is, platinum is. You can just go in. I like everything I look at is putting in bottoms for commodities. Everything. The Nasdaq, I mean, that thing's gone vertical for a little while. That looks like a blow off top. This should all make sense when you look at it from this perspective. It's in full alignment for this to break lower where the Nasdaq underperforms. And that is really important to understand. It's not one chart that does it for me. It's the thousands of charts that I look at that paints a picture that we're in a commodity bull market that has just started, like just started. And we're coming through either stage one bases here or entering stage two. They're all located there. There's no way that that's a fluke. Now, some people will say, well, what about a recession? It's only going to delay it, guys. It will delay the move. It won't stop the move from occurring. It won't. The recession will break this down. NASDAQ will fall. Commodities could fall with it for a period of time. And then I think commodities are going to rip if we get that type of outcome. And I don't think we are because I don't see the 2-year yield dropping like a rock. Dropping like a rock. So, yeah, that's what I'm seeing there. Peter Schiff, investors and the Fed continue to ignore the obvious. The U.S. economy is weakening just as inflation is strengthening. And that's exactly what we're seeing here in this chart. It's likely that by the time the Fed cuts interest rates, GDP will be negative, unemployment will have spiked, and the year-over-year CPI gains will be closer to 9% than 2%. Now, here's the thing that I will say there. We don't see that 2-year yield dropping. And maybe we get a slowdown. Maybe it is stagflation like some people are expecting. Maybe we get a weakening of the economy at the same time that inflation is ripping it and interest rates go up. I don't know what the heck the Fed's going to do there. And that's what Peter Schiff is saying. Like, what are you going to do if the consumer price index is up around 9-10%, but you've got the economy that's weakening? Like, what are you going to do? You're gonna hold interest rates high and just destroy the economy, or are you going to lower interest rates with inflation going up massively if they lower those rates even further? I mean, they are screwed. They are in such a bad situation here if that outcome does exist here, which to me, it looks like that outcome is a high probability. So we could get a recession at the same time that commodities go skyrocketing like the 1970s. And that's where I'm so reluctant to sell anything because of a potential recession. It's like, guys, they're printing money like it's going out of style here. It's almost like they're trying to hide that we're in a recession already because you do hedonic adjustments on the consumer price index. You put that number lower, it's going to pump your GDP number up if you do that. Uselink says URA is about to make its highest monthly close in 10 years, and no one seems to care about it. And it currently is well underway in a major wave 3 up. Also measured versus the uranium metal is itself, the Wyckoff accumulation has played out. I might be the only one, but I am bullish all over. I'm bullish too. And you know what's interesting on uranium? How many of the junior companies are participating in this move? There's not many of the exploration. We've seen the developers; they're starting to run, and we obviously have watched the major producers run. I think we're still very early because the explorers have not had their big moves yet. So uranium, yeah, we're up around 10-year highs. We continue to work its way on up. The name of the game here is don't try to play the short term. Just ride it on up. Don't worry about the short term. If you don't worry about the short term, you don't worry about a potential recession. And yes, it could go down if we get a recession. It could. But what if you just play the long term, ride through it? Screw it. It makes life so much easier than trying to time short term stuff and get all worked up and frustrated in the short term. And if you take a long enough time frame and are patient enough, you won't even get worried about it moving sideways for a period of time. And I hate to say it, guys, but if you've been in this since 2020, like when I have, it's only been 4 years. And I'm up like massively in all my uranium stocks, the ones that I purchased in September, October, November of 2020. They're up huge. Like I have no complaints with any of the stocks. I think what's occurring is a lot of people are trying to time the short term and they're just getting all sorts of twisted and turned around in the markets. It's not good. It's unhealthy to be that frustrated and I'll say disappointed in a sector. It's up over the 4 years that I've invested. So what I'm going to say is your entry point is absolutely critical. And that's exactly what I focus on is entry points and not trying to play the short term. And if you've got good entry points, take them, buy the shares, put them in your account and lock them away for 5 or 10 years. And you'll probably have at some point in every stock that you own, if you don't time it perfectly, which no one will, you're going to be down on the position when you first buy it. That is completely normal. So you have to have some sort of conviction in the sectors that you're buying. You're not going to be up the entire time unless you buy something into strength out of a breakout and you try riding it up. But mentally, you got to prepare yourself for being down in the short term and then ride these things for many hundreds of percents, maybe even thousands of percents gains. That's the only way that I know how to make an obscene amount of money from the markets. And it rarely does that going up straight, in a straight line. Rick Rule Rhetoric says the world needs more electricity, and for the next 50 years, much of it will be supplied by hydrocarbons. Irrespective of what we do or think, that's just the reality. I love it because it's true. It says this is your decision. Struggle now, enjoy later. Enjoy now, struggle later. You have to pick one. Well, I don't know what struggle even means anymore. Weak, I'll just say this. Weak people think that not spending money is struggling, but they're doing just fine. It's not like they're living in a third world country struggling to eat. So struggling now is not really struggling. It's living now and not spending a lot of money and enjoy later versus enjoy now or struggle later. Now, here's the thing. If you just lower your expectations, it's not even struggling, in my opinion. So when I lived in my 20s, I still drive the same car. I drive a cheap car. We've been driving cheap cars in our family for a long time. They are like, if you looked at it, you'd probably say, why are you even driving that on one of the cars? It is pretty beat up. We keep it outside. It's all sun faded and it's been in a couple of accidents. I've fixed it, and we can continue to just drive it for short distance trips. We leave the car outside. We don't really care about it. It's liability insurance only, very cheap transportation, and it is reliable. There's no problems with it. So I continue to keep driving it because I'm milking the crap out of it. Is that what struggle now means. Is struggling now mean like I don't know what struggle now necessarily means. I don't think I've ever struggled in my life, like really, really struggled. And what I mean by struggle, I mean like I was literally skipping meals because I couldn't afford it. That's never happened to me. That's what I think struggle now means. Saving now and enjoying later, that's a little bit different. You're not really struggling. But if I did have to choose one, I'm a saver, so I would choose struggle now, enjoy later, or save now and enjoy later. I have a problem with enjoying things. I'm the guy that would have a half a pillow full, a pillowcase full of candy for Halloween, and I wouldn't eat all of it. In fact, I would try to save it still, and I just never really ate the candy that much. Actually, I never really enjoyed candy that much, but I'd eat a little bit, not all the time. So I don't know. There's my opinions. Energy remains the most profitable sector with the highest level of free cash flow. Evidence that the market doesn't buy the implied commodity prices, that the commodity prices will remain at or above current levels, or that the sector is deeply undervalued. It's deeply undervalued. My largest holdings on a percentage basis are in the oil and gas area because of this undervaluation, guys. It's stupid cheap. I love it. I absolutely love that sector. I love it, and I can't stop buying it. It's ridiculous. Jesse Day, he's got one of the guys that he interviewed here. What we have is really a perfect setup for commodities. Explains why out of control government debt, inflation looming large, and geopolitical uncertainty is setting a stage for commodities to outperform. I remember his name. It's like Jim something. I can't. Slips my mind. Here's Mike Simonson. He says it's really hard not to conflate what is from what should be. And I live in the what is, but a lot of people live in the what should be. A lot of people argue with what should be versus what is. So this is why I wanted to read this. It says a huge challenge in our social media world is that people conflate factual observations about what is happening with the value judgments about what they should feel happen. It goes both directions. We start with our values about how the world should be. We seek and share facts to support our values. If we encounter facts that are contrary to our values about what should be, we assume the sharer wants these facts to be this way. It happens to me all the time. I shared a factual observation that boomers aren't selling their houses. Comments in the thread are about why I don't want boomers to sell. I don't want either. On the other hand, I do want immigration. I often share data that shows us why immigration is so wonderful. I want people to absorb pro-immigration facts. I feel like I have to fight all the anti-immigration vibes these days. I wonder how I can change my behavior to be more effective at both of these things. What I see a lot of people who live in the what should be, and then they share their opinions, and then they try to form the data to back that opinion. I live in the what is camp, at least of what I think of what is. I am a housing bull because of the data. And my viewpoints are all based off of the data and the way that I read and view the data. It's not about how the world should be and then try to make the facts fit that. I look at the world, I do the math, and then I'll say, you know what? The sun is the center of everything because the math is the easiest to work out. While everyone else is trying to make the math work on a geocentric world where the earth is in the center and everything else rotates around the earth, which is around them. So a lot of people talk about all of these things that are based off their opinions and try to make the data fit their opinion. And obviously people are going to say, well, you're biased, everyone's biased. I try not to be, and I try to have my opinions around the facts. States that have shrinking population in 2023 A lot of people say, why do they have shrinking population, or what's the common denominator here? They're all high tax states. New York's high tax. Hawaii is. Well, I'm not sure Hawaii is. I think it might be. Illinois definitely is, and California is, and Oregon is, depending how you look at what taxes you're looking at. But most of these states that are in this, I don't want to live there in any of them. None of them. Perhaps a retest for oil today. That's what I wrote, and it does look like it's trying to do a little bit of a retest here. Someone had written in here that they put the line through here, and I'm like, no, 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 no. You wouldn't have a downward facing falling wedge. Sorry, you'd have an upward facing rising wedge, and that's why I disagree with it. U.S. gas-fired power generation has been steadily marching higher for decades now. We think emergent demand from AI and data centers could reinforce this trend. Big move up. You can see the seasonality on this for the winters, and it is moving on up for natural gas terawatt hours. Crude inventories fell by 24.3 million barrels in March, while product inventories rose by 0.4. So here's product inventories still right at the 5-year average, and this is really low for crude oil closing inventories, 2024. Looks good for oil to go higher if we continue to see deficits in oil. Indian power demand hits an all-time high. The nation reported maximum demand of 246 gigawatts on May 29th amid a heat wave. The records for peak electricity demand have risen each fiscal year, as India's power needs surge. We're surging in electricity consumption everywhere, guys. Ridiculous. That's where I'm going to end it. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you want to. And we'll catch you next time. This is Finding Value.